Imagine a single scribbled note, "I'm afraid there's no money," intended as gallows humor in 2010, morphing into a decade-long austerity act that chopped Britain's future. Public debt doubled from 55% to 100% of GDP despite the cuts. GDP per capita froze like a glitchy screen for 15 years. Last month, recession. The Joseph Rowntree Foundation warns the average household loses £2,000 by 2029. QE and rock-bottom rates pumped a housing bubble, not factories. HS2's £50 billion ghost line embodies Britain's paralysis. Planning laws that take a decade, costs triple peers, political U-turns. Brexit shaved 4 to 5% off GDP. Productivity lags 25% below pre-crisis trends. Immigration swells GDP but squeezes per capita NHS, schools, roads. Waiting lists at 7.6 million, structurally permanent. Debt interest devours £120 billion yearly, more than education. Regions rot outside London. Councils bankrupt. Life expectancy gaps widen. Low growth. High debt. Higher taxes to pay bondholders. Vicious spiral. Without slashing red tape, devolving power, building homes and renewables, taxing smartly not punitively, the script writes itself. Fraying services, rising inequality, irreversible decline. Can Britain reboot, or is the punchline permanent? Story. The UK's post-2009 economic saga is a dark farce where a throwaway joke ignited a policy wildfire, scorching growth, investment, and public trust for over a decade. It starts in May 2010. David Laws, outgoing Liberal Democrat Chief Secretary to the Treasury, leaves a note for his successor. "I'm afraid there's no money," meant as sardonic wit amid the global financial crisis wreckage. The incoming conservative Liberal Democrat coalition seizes it like propaganda gold, brandishing it to justify savage austerity. George Osborne's emergency budget slashes departmental spending by 19% in real terms over 4 years, targeting welfare, local government, and capital investment. The rationale: repair labor's supposed fiscal recklessness. The reality: it amputates the recovery. Growth sputters through the 2010s. The Office for National Statistics later confirms a double-dip recession in 2011 to 12, partly self-inflicted. Public investment plunges from 3.5% of GDP pre-crisis to under 2%, among the OECD's lowest. The Bank of England counters with emergency measures. Interest rates slashed to 0.5%, then held near zero for a decade. Quantitative easing, QE, pumps £895 billion into bond purchases by 2021. This keeps government borrowing artificially cheap. 10-year gilt yields dip below 1%, but the stimulus misfires. Cheap money floods property. House prices rise 50% in real terms from 2010 to 2021 per nationwide. Business investment? Stagnant at 10% of GDP, bottom quartile OECD. Firms sit on cash piles, productivity flatlines. The punchline lands cruelly. Public sector net debt was 55% of GDP in 2010, excluding bank bailouts. By 2024, it's 98% and climbing. Austerity shrinks the economy, shrinking tax revenues, ballooning the debt ratio. Lower growth means every pound of debt buys less future output. The Treasury's own models later admit, had investment been sustained at pre-2010 levels, GDP could be 5 to 7% higher today. Fast forward to 2024. The bank unwinds QE via quantitative tightening, selling £100 billion plus in bonds annually. Private investors must absorb this supply, pushing up yields. 10-year gilts hit 4.5% in 2024, doubling borrowing costs. Debt interest payments exploded to £120 billion last year, surpassing education, £100 billion, and defense, £60 billion. Taxpayers labor harder to enrich bondholders, many overseas. The Office for Budget Responsibility, OBR, forecasts debt peaking at 110% of GDP by 2028, then drifting higher if growth averages 1.5%. A vicious cycle: low growth, high debt, high interest crowded out investment, lower growth. Public services bear the scars. Infrastructure leans on 1960s, 70s vintages. Motorways cracking, water pipes leaking 20% of supply daily, schools with RAC concrete collapsing, over 150 closed in 2023. The education budget, real terms cut 9% per pupil since 2010, manifests in leaking roofs and teacher shortages. The NHS, elective waiting lists hit 7.6 million in 2024, up from 2.5 million pre-pandemic. The Institute for Fiscal Studies, IFS, warns of a new normal, structural elevation, with only modest declines forecast even under optimistic plans. Courts backlog 67,000 Crown Court cases, prisons overflow. Both Labor and Conservatives now pledge fiscal responsibility, debt falling as a share of GDP within 5 years. Translation: more capital cuts. The March 2024 budget penciled departmental spending rising to £477 billion by 2028 to 29, but OBR head Richard Hughes called the plans a work of fiction. No detail on how. High inflation, peaking 11.1% in 2022, eroded real budgets, yet envelopes stay cash flat. IFS calculates unprotected departments, justice, local government, FE colleges, face 3.4% annual real cuts to 2028. Factor population growth, net migration 745,000 in 2023, and per capita cuts hit 4%. Services stretch thinner even as absolute GDP ticks up. HS2 epitomizes Britain's building sickness. Conceived in 2009 at £33 billion, costs spiraled past £100 billion by 2023 amid planning delays. 8 years for Phase 1 consent, land compensation inflation, and design changes. Rishi Sunak cancelled the northern legs, leaving a £50 billion stub from London to Lichfield. Least beneficial, most expensive per mile. Comparative data stings. France's LGV estate cost €30 million per kilometre. HS2 Phase 1. For £100 million per kilometre. Culprits: fragmented procurement, judicial review culture, political meddling. 5 transport secretaries in 4 years. The National Infrastructure Commission estimates UK megaprojects cost 2.5 times European averages. Policy volatility compounds uncertainty. Corporation tax, 19% in 2017, hiked to 25% in 2023, with 4 changes since 2019. Liz Truss's September 2022 mini-budget unfunded £45 billion tax cuts crashed gilts. Yields spiked 150 basis points in days, forced U-turns, and triggered the biggest tax rise in history, £25 billion via frozen thresholds. National insurance cut 2p in 2024, but bracket creep drags millions into higher rates. Business investment fell 1.5% in 2023. OECD ranks UK 28th out of 31 for capital stock growth. Productivity is the silent assassin. Output per hour grew 1.8% annually pre-2008. Post-crisis, 0.4%. A 25% shortfall versus trend. Global headwinds, aging, post-industrial shift, affect all rich nations, but the UK lags peers. The Resolution Foundation attributes half the gap to underinvestment in R&D, 1.7% of GDP versus OECD, 2.4%, and skills, apprenticeships halved since 2010. Brexit accelerated the rot. June 2016, 52% vote leave. Sterling plunged 15% overnight, never recovering pre-referendum levels. The Trade and Cooperation Agreement, finalized Christmas 2020, imposes customs checks, rules of origin paperwork, and service barriers. EU exports are down 15% since 2019. Small firms, under 50 staff, report 30% drop in EU sales. The OBR estimates a long-run 4% GDP hit. UK in a changing Europe pegs 5.5% by 2030. FTSE 100, global firms, outperforms. FTSE 250, UK-focused, lags. Investment intentions collapsed post-referendum. Uncertainty lingered through 5 prime ministers and 3 deals. Energy vulnerability exposed the missed 2010s window. With cheap borrowing, the UK could have built offshore wind, nuclear, interconnectors. Instead, capital budgets slashed, Hinkley Point C delayed to 2030s. 2022, Russia-Ukraine war spikes gas prices. UK imports £100 billion in energy, highest ever. Windfall taxes followed, deterring North Sea investment further. Housing distorts everything. Prices rose 60% in real terms since 2010, rents 30%. Supply: 230,000 homes built annually versus 300,000 target. Social housing stock fell 200,000 since 2010. The Joseph Rowntree Foundation projects housing costs up 15% real terms by 2028, consuming 35% of median income for private renters. Homeownership for 25-34s, 63% in 2000, 39% in 2023. Temporary accommodation homelessness up 74% in a decade. Wealth inequality surges. Housing now 60% of UK net worth. Demographics tighten the noose. The over 65 population rises 20% this decade. Health/pension spending up £30 billion. Working age participation falls. Long-term sickness claims double to 2.8 million, costing £18 billion in benefits. Labor shortages despite recession, 1 million vacancies. Productivity drags. Regional chasms widen. London's GDP per capita, £60,000. Northeast, £30,000. Levelling Up allocated £4.8 billion. The local government has lost £15 billion since 2010. 20 councils issued Section 114 notices, effective bankruptcy, in 2023 to 24. IPPR forecasts inequality rising to 2030. Healthy life expectancy gap, 19 years between richest/decile postcodes. The current account deficit, 4 to 5% of GDP persistently, signals structural weakness. UK imports manufactured goods from Asia, exports services concentrated in London. Twin deficits, fiscal plus current account, mirror 1980s US, reliant on foreign capital inflows. Sterling vulnerability looms. The outlook is binary. Stick to fiscal rules without growth. Taxes hit 38% of GDP, post-war high. Services cut 20% real terms per capita by 2030. Or reform radically. Planning revolution, zone land for development, cut judicial reviews, mandate local plans. Investment surge, borrow at 4% for 20-year projects yielding 6 to 8% social return, infrastructure, R&D, skills. Tax shift, lower corporation/income rates, raise land value tax, carbon tax. Devolution 2.0, fiscal powers to metro mayors, multi-year budgets. Brexit pragmatism, veterinary agreement, mutual recognition, youth mobility. Housing blitz, 100,000 council homes annually, compulsory purchase of unused land. Without this, the Joseph Rowntree £2,000 household hit by 2029 is conservative. Real wages stagnate, inequality entrenches, social cohesion phrase. The 2010 note was a jest. The joke now is on every Briton paying higher taxes for crumbling services while asset owners prosper. Decline isn't destiny, but escaping demands courage politicians have dodged for 15 years. The script can change. Will it?